Canadian real estate investment trusts have rallied to their highest levels in 5 years on the strength of rising occupancy rates and strong investor demand for yield. They're also becoming takeover targets. Since the beginning of the year, there have been 4 major deals in the sector, all involving hefty premiums, and some say the fundamentals will stay strong even as interest rates rise. Jeffrey Olin is the president and CEO of Vision Capital, a real estate investment firm. Great to have you here.
Thanks very much.
Let's start with the M&A activity, because it really has been, for a field like this, it seems like kind of a flurry. What's driving it? Why is now the right time for all of these deals?
The fundamentals for Canadian commercial real estate are better than I've seen in 30 years in terms of supply and demand. And over time, supply and demand has trumped interest rates every time. And we have low single-digit vacancy rates in virtually every property type in every region of the country. The Toronto and Vancouver condo market I find a little bit scary, and I've been wrong on that for 5 years. But we have seen, in my opinion, the Toronto condo market is not going to turn. It has turned. But the rest of the country is solid. People have jobs, and employment levels are strong, and fundamentals are excellent.
That comment on the Toronto condo market, I'm a big REIT investor, and I look every day. I get a sheet sent to me at the end of the day on price per square foot transactions that occurred that day. I'm waiting for this thing to break down. Where do you think we are in the cycle?
It has broken down. You can stop waiting. I think I was meeting with a significant buyer of wholesale. They buy a bunch of units pre-sale. They haven't bought in some time. I think the Toronto condo market has turned, and it's going to soften.
The high end, because they're trying to market places at $1,800 a square foot right now.
I think the high end will hold up better. 80% of the condos that have been sold in central Toronto are being sold to investors to be rented out. And the economics of that rental equation is not working, and people have been buying them based on capital appreciation, and I think that part of the story is over. Having said that, we haven't had rental apartments being built because of rent controls in over a generation, and they're replacing that to some degree, and we still have strong immigration that's helping take up some of that slack.
Now, not all of our viewers will know exactly what a REIT is or why you would invest in it. So can we just go there for a second? Really, I think, historically, there's something that you would invest in for yield. We're seeing these huge capital gains, of course, lately. But how do they work? Why are they a good investment?
We would disagree with your premise, although that is fairly commonly accepted. We would look at a REIT or any investment on a total return basis. Okay. So you can get a 5 or 6% yield and have a 10% capital loss, and that's not a good investment.
Right.
REITs, consider them like stocks, except they're focused on real estate and they have tax efficiency. They pass the same tax advantages of you owning the property directly through to investor in a public form. So they're like real estate stocks, except they're more tax efficient.
And what kind of yield would you get these days on a REIT? What are we talking about?
Again, we look at a total return, and some of our large holdings, in fact, I think our 3 largest holdings have no yield. We look at total return. The answer to your question is REITs are yielding between 3.5% at the low end to 7% at the high end, most of them in the 5% range.
Do investors understand when they buy a REIT that they're also buying into a tremendous leverage? Because most real estate has a tremendous amount of debt on it. Does that concern you at all if we're at the bottom of the rate cycle and they start going up? Does that impact REIT prices?
It doesn't concern me. It's something we monitor. It doesn't concern me for the following reasons. First, REITs are very conservatively leveraged. I worked, if you remember, companies like Bramalea in the 1990s. When I worked there, we had interest coverage, just had enough cash flow to cover our interest. It was, in terms of financial speak, 1.1 times interest coverage ratios. Today, you see these REITs financed at 2 to 1 or higher. And the 1980s are a perfect example of where you had a period of high interest rates, 10% interest rates. Never mind 1981 when they were 18, 19%, but 10% interest rates near the end of the decade. And property values were still appreciating because the fundamentals were solid. Inflation was high, which is not a factor today, and rents were going up. And so if you look at the supply and demand fundamentals, they're excellent. The other thing is, if you look at the spread between property returns, as defined in real estate speak as the cap rate, but the unlevered return, or the return without debt, the spread between those returns and long-term Canada bonds, today they're about 70 basis points higher than historical average. So investors are underwriting are building into prices an expectation that interest rates are going to go up, which we don't think, but if they do, I think that the fundamentals trump interest rates.
You've actually got three, I think, that are your sort of top picks.
Yes.
Can you tell us why, starting with Morguard? What do you like about this investment?
They all have similar themes, but Morguard is 18 million square feet, large diversified entity, well managed. It's trading around $92 a share. Independent appraisals, $155 a share. It's a perfect example of why our fund exists, the inefficiencies in the marketplace. It's an outstanding entity, and it's cheap.
Similar for Main Street Equities?
Main Street is growing from 270 apartment units in 1998 with $1 million to 8,000 units with $10 million of net equity. It's in apartments. It's worth $33 to $37. It's trading at $24.
I look at those charts and I wonder if interest rates went up 200 basis points, what would they look like?
I think, again, in Main Street's case, it's blessed by having access to CMHC mortgage guarantee insurance. And, with 10-year bonds at 2% and with CMHC money financing 70 to 100 basis points, these are conservatively, Main Street has properties with no debt on them at all. And so they're concerned. Look at the coverage ratios. They're very solid. We're
not done with the M&A, right? By all accounts, there are others out there that are likely takeover targets.
We think so. The analysts have been proven to be conservative or wrong, however you want to label it. They've missed the NAVs. These takeovers are taking place 20% higher than analyst consensus values. So,
in the crazy times, cap rates got down to 4.5%. We're a little more conservative now, 5.5%, right? Where's the range?
I think you're hitting the fours on some of the apartment transactions.
That's nuts. That's the high.
So
that's nuts.
Jeffrey, great to have you here.
Thanks very much.
Jeffrey Olin, President and CEO of Vision Capital Corp.